Right, good afternoon, ladies and gentlemen. So what you're looking at here is a 4 megabyte hard drive, and I'm rounding up, being loaded onto a cargo plane in 1956. You couldn't buy it, but you could rent it for $35,000 per annum, and it weighed nearly a ton. I think I'd need about 10 of these just for this slide deck, to be honest. And 60 years later, we walk around with this device in our hands. Email, GPS, 100 gigabyte hard drive, it really is a story of exponential change. I think if we start looking at market cap weighted funds or the reverse index funds and smart betas, I'd like to start just with a quick recap of what's different. Your market cap weighted fund really is your buy the market cheaply, buy the market as fast as you can. It's buying something such as the top 40 index fund or the Capstrix index fund. The fundamental theory, though, is it puts the market at the center of the universe. So if a share is 10% in the index, the fund's going to hold 10%. If it's 1% in the index, we're going to hold 1% in the fund. In your smart beta funds, the fundamental difference is that as opposed to putting the market at the center of the universe, we put the market economy at the center of the universe. So it breaks that link between the size of a share in the market and the size of the share in the portfolio. It's now holding shares based on certain characteristics, based on a ranking on value, based on a ranking on momentum, based on a ranking on quality. It's a fundamentally different way of actually building out your fund. I think certainly as a market, we don't help ourselves much in terms of these funds go by so many different names. Scientific-based investing, factor-based investing, fundamental-based investing, smart beta, but they're all exactly the same. And probably my personal favorite was the advanced beta, because there was a school of thought at one stage that thought, well, if these are called smart beta, then are these the dumb beta? But I think that we were over-engineering it. But I think also a very interesting fact is that if you look at the S&P 500, you've got 500 shares. On the S&P 500, there's more smart beta funds on those 500 shares than there are shares. Now, how on earth do you go and pick something there? I think what's really powerful with these funds, both the market cap weighted funds and the smart beta funds, is that once clients understand what they've actually bought, there's a lot more comfort in terms of how that behavior and those returns pan out through time. And they really help to keep clients invested and to run the journey, which we've heard more than once today. We're all aiming to keep clients invested through tough times. Tough times through noises on shares, noises on cryptocurrencies, Brexit, and of course, global warming. So what we did is we then went and unpacked in the SA market some of these risk premiums in that equity block to try and see what was the story, what did we see, what did we evidence. The first one we looked at was size. So how did the small cap shares compare to the large cap shares? Showing if it's above the graph, the small caps are doing better, below the graph, large caps doing better, and these are rolling 12-month returns. If you look at value, you can see also quite a nice picture here, a time and space where value is really doing well, but then a very long period where nothing happened. And this is one of the risk premiums that we've built a smart beta fund on. It was the first one that we built, as I'm going to show you later. It's been running now for 2 years. The third factor, momentum. And again, you see a picture. This risk premium has really shone in our SA markets for a long period of time. Not surprising, if you look over the period 1996 to I think it's 2014, we've been in a very strong equity bull market. So not surprising to see that this risk premium has been featuring strongly during this time. It did pose us with a very interesting naming challenge, though, because the first time we just called them the Momentum Equity or the Momentum Value Equity Fund. This one was a challenge, though, because the Momentum Equity Fund sounds like we've lost our way slightly. Momentum Squared Fund, I think only the actuaries would know what I was talking about. And the final one was growth. How did that growth risk premium feature through sort of different rolling 12-month returns? Where the real power came from, though, is that when we then said, right, how do we blend them together? So in that equity building block, if we break up the block between how much into value, how much into momentum, how much into size, and we're going to analyze it on a 3-year return basis and look at how the returns come out relative to the market returns. So is this risk premium doing better than had I just bought the market? It tells quite a fascinating story. So in value, on a 3-month rolling basis, red dot being the lowest observed return on a rolling 3-year basis, blue dot being the maximum, and gray being the average, you can see a range between probably minus 5% and 8% above or below what the market would have done on rolling 3-year returns. We looked at core, we look at momentum, a slightly wider range, and deep value, I'm sure no one's surprised to see, has some rather harrowing times, either doing exceptionally well or doing exceptionally badly. But the real power, when we blended these risk factors together into the portfolios, is that on a rolling 12-month basis, first point, it never underperformed the market on a rolling 12-month basis, and that funneling in of returns was a fantastic attribute to get in your equity building block, within that theme, once again, of reducing volatility and keeping clients invested. So when we go about constructing this equity building block, how do we go about it? What do we think about? And effectively, it's these primary themes. The first one, we have to diversify by style. So within the actual equity block, it's not good enough to just go and diversify between 3 managers. They might all do the same thing. So it's all about breaking it up into blocks that actually do things differently. So we go and diversify by style. We then introduce this theme about, once I've decided how much of that equity building block to now allocate into value or how much to allocate into trending, I don't always have to go and use active managers to go and implement that. We can go and do it passively using smart beta funds that I'll show you. And then when we come to implement, we then implement with different managers, the best manager or the best smart beta fund we can in each of those blocks. So for us, diversification is at 3 levels, as you've seen here. And really what it does, as I showed you, is that to go and bet the farm on any one style on a forward-looking basis, you're going to be in for quite a bumpy ride. Blending the styles, though, we get a far smoother journey in terms of how this evolves and how it unwinds through time. We did quite a lot of work locally, and there's certainly the same amount of research done on a more global basis that says if you try and time these equity risk premiums, so you try and make a call, right, for the next quarter, I think we should overweight momentum or we should downweight quality, you're more likely to get it horribly wrong than to actually get it right. It's all about building a portfolio that incorporates these risk premia and then let that portfolio run. Don't try and upweight, downweight your styles as you go through time. And finally, I think a hell of a lot's changed in the market. I mean, I remember having a conversation with clients not even that long ago, 7 years ago, where the whole conversation was, should I be active or should I be passive? We've moved so much further past that now. It's now all about how do you use both together? How do you blend it? What's the best way to actually blend these two to get the best possible outcome in terms of this equity construct? So then what I saw is that we said, okay, let's go and have a look at how these 3-year active returns play out on the 3 primary risk factors or the 3 primary sources of market beta that we're trying to actually capture. So value on a rolling 3-year basis, you can see it's quite a wild journey. Quality, started well, got a bit tempered towards the end, and momentum. Which one would you pick for the next 3 years? I certainly don't know. If you do know, please give me a call. I'm delighted to hear your view. But I mean, you can see it's an incredibly tough position to try and make. The real power, as I've shown you, is when you blend. Now, even in our own portfolio construct, up until fairly recently, we've primarily been blending with value and with momentum, and then bringing in size. We haven't actively looked to put quality into the portfolios. We've done a lot of work now, and we're currently in the process of actually implementing that factor. So what we've shown, or what we found, is that if we looked at our equity construct, and on the old strategy, which had no quality in it, how did that mix perform? And this is not the actual returns that we've derived, it's just looking at that risk premium, how it unfolded in the market. And if we add quality into that mix, so now in that equity block, we don't just have value, trending, and size, we now have value, trending / momentum, quality, and the rest of the market. The main thing which is positive is if we want to see that that blue line is higher than the red line. So adding quality into that equity building block provides an equity portfolio that's more robust and that has a better, a far better payoff profile than a portfolio that doesn't have quality. I mean, even personally, even a shorter time frame, 4 years ago, I wasn't convinced quality had a role to play in our own portfolios, but I think we've evidenced now it certainly does have a role to play. The proof is in the detail in terms of how you actually put it into your portfolio. I think what you've seen is that in terms of how we build portfolios as well, it follows a well-structured process where we're actually isolating how much value, how much trending, and then we're implementing managers and stories in those blocks. So we have full control over how much is in each of those styles in the portfolio. If you blend with 3 managers and they start drifting in style, you have no idea how much exposure you have to any of these styles at any one point in time. I'm also going to just touch on that if you look at smart beta funds, no 2 smart beta funds are the same. There's a lot of differences between them. And I'm going to highlight 4 factors that we believe are vital for you to consider when you're considering the merits of different smart beta funds. The first is the word index. Sounds like a real, like, why on earth is he mentioning this word index? If you do a unit trust, per the FSCA guidelines, if you want to use the word index in your fund name, so Capped Swix Index Fund, SA Property Index Fund, if you have the word index, you need to have an appointed calculation agent, which can only be the JSE, S&P, and a few other large financial services players who go and calculate that index for you on a daily basis. If it's not an index that's already in use. So if you do the Capped Swix, it's in use, you can just use it. But that costs you a hell of a lot of money for them to run that index for you. And number two, you then have to pay further licensing fees as that portfolio gets assets into the portfolio on your own index. That I just couldn't get my head around. So it's my index, my proprietary information. We get assets and now I've got to pay more fees. So it makes it very expensive to use the word index if it's not a well-known market index. But the bigger reason is this last one, rebalancing. So when you do your run at the end of the month and it says, right, in your particular smart beta fund, these 3 shares are in and these 3 shares are out, the worst thing you can do is for a manager to start thinking, okay, I need to pull that trigger today because I need to keep a tight tracking error to that index. What poor investment behavior. If you rebalance, it's all about getting into and out of the market with the least friction and with the best possible outcome for your clients. And that's completely in contradiction if you're trying to be benchmark cognizant. It's exactly what you do in a Cat Swix fund. You try and stay as close as possible. But in a smart beta fund, it's one surefire way that you're going to wipe out client money. The second factor, and we heard it from Dr. Vilma earlier, is that this concept of multi-factor. And she showed you even in the live demonstration, when they screen shares, they're screening them on different lenses. Momentum in her example, value, broker earnings revisions. So the key factor in our research is that you want to have a multi-factor smart beta fund. The worst thing you can do is have a fund that picks a share based on one lens. It can do spectacularly well at times and then crash spectacularly as well because that factor just doesn't work anymore. So this, I think, is a key one. And the final one is tracking error. How aware or cognizant are you going to be of what's happening in the market? Are you going to build a smart beta fund that's pure, and does the best at capturing that particular risk premium, and they're going to ignore what the market's doing, or am I going to take into account somewhat what the market's doing? And I think there's no right or wrong, but the danger of ignoring the market is that if for argument's sake, in a Capped Swix fund, if you don't like NASBAS, that's a big bet to hold naught in NASBAS. You're going to get a big tracking error just because of one share. So these are the 4 factors that we believe are certainly worthy of merit, and that played a big role in how we designed out our own smart beta funds that I'll quickly share with you. So our 2 smart beta funds have got a 2-year track record. Probably one of the worst things in terms of actually taking it to market. We haven't been telling the story actively to market yet. They've got around 7 billion in each strategy, which they've been running since inception. Anybody know that Momentum had 2 smart beta funds with 15 billion worth of assets? Show of hands. What a wonder. We did a great job of keeping that undercover. And they've got incredible results. Both of them are in unit trust surveys, so you can see them on Morningstar, all of the likes. But the challenge is, you now want to have a very small select group of audience that actually will know now that the Momentum Value Equity Fund and the Momentum Trending Equity Fund are both smart beta funds. At the beginning, we were thinking, should we get that word index, yes or no? And you can see why we didn't. But they are 100% smart beta funds. Where the discretion comes is when we execute. And Dr. Vilma also showed it earlier. Because you're worried about market manipulation, you're worried about actually not trading with a gun to your head. When the index when it says, right, these 3 shares in, these 3 shares out, there's no panic, there's no rush. Whether it takes a day, 5 days, 10 days, they'll rebalance in the most appropriate way. That's the only part that's got that sort of element of market discretion to it. The $1 million question, though, how have they done? So this is with 2 years of track record. They were launched in around April 2017. And each running with about 7 billion in each of those 2 funds. There's about half sitting in the unit trusts and half are sitting on the balance sheet. Believe me, it's very different to run 200 million proof of concept funds to running 2 7 billion rand funds. You really need to be on top of your game. It's a very different story. So if you look at the ASISA general equity category, there's about 170 funds, 165 funds in that category. The peer group average for the 2 years ending 30 June was 4.7% per annum. Capped Swix did 4.6% per annum over those 2 years ending 30 June. So if you bought all 160 funds, you would have done slightly better than market across 160 funds. Our value equity fund did 15.2% per annum, and our trending fund did 15.3% per annum. What a great story. What a wonderfully kept secret. I'm so glad we kept it hidden from everyone. But these are the kind of building blocks that are available that demonstrate that power of smart beta. The really bad question is clients saying, oh, well, should I buy value or should I buy trending? Hopefully you're all now well educated that it's a far better discussion to have around how do I incorporate these into my portfolio? How do I decompose that equity block into its themes and then bring building blocks like this in? Who's surprised by those returns? Anyone? Fantastic to hear. In the Morningstar survey, please take a look. The only thing you have now is that you do know they are smart beta funds. I think you'd agree with me, it's been a hell of a long day, so I thought, this is my last slide. No story should end without a little bit of humor. So I thought I would leave you with one of the great stories that I heard. And the story went as follows. So it's sitting on a park bench one afternoon with these two gentlemen. On the one side, a genius, and the other side, a moron. And when I heard this story, I thought, like, oh my word, where's he going with this? Is this going to end well? But it ends fine. So these two guys get chatting, and the genius says to the moron, he says, you know what, I think we should play a game. He says, I'll ask you a question, and if you don't know the answer, you got to give me 50 rand. But he says, we'll make it fair. Don't panic, don't panic. You can then ask me a question, and if I don't know the answer, I'll give you 500 rand. So the moron, being the moron, says, yeah, that sounds like a great game. So the genius says to him, okay, well, it's my game, so I'll start. So the genius sits and he thinks and he thinks, and he says, okay, can you explain to me Einstein's theory of relativity? So the moron looks, and he thinks, opens his wallet, gives him 50 rand. So now it's the moron's turn. He sits there and he thinks, and eventually says, okay, what goes up the hill on 3 legs and comes down the hill on 4 legs? So the genius is like, wow, writes that down, works on it. After 2 minutes, he's got nothing. So he opens his wallet and he gives him 500 rand. And now he's seething. So he looks at him and he says, okay, pal, so you tell me, what goes up the hill on 3 legs and comes down the hill on 4 legs? So the moron looks, he thinks, opens his wallet, gives him 50 rand and says, I don't know, you got me.